Today, we're going to unravel a massive market mystery, a real financial thriller. This is the golden illusion, and we're about to dissect a crash that, on paper, should never have happened. Okay, think about this. We're all told the same thing, right? When things get crazy, gold is your shield. It's the ultimate safe haven asset. So, what in the world happened in March of 2026? You have a huge geopolitical crisis blowing up. Oil prices are screaming higher. And gold, well, it does exactly what you'd expect it to do. At first, it rockets to an unbelievable record high, over $5,500 an ounce. But then, right when the world seemed the most dangerous, it just falls off a cliff. Why? What gives? And that right there, that's the heart of the mystery. We're calling it the safe haven paradox. The one asset that's supposed to protect you in an emergency completely reversed course and did it violently. So let's investigate. Let's break down exactly what happened piece by piece. Okay, look at how fast this all went down. The speed here is just staggering. At the end of February, the crisis kicks into high gear. By early March, gold is on top of the world, a record $5,589. But then, just 2 weeks later, by March 16th, it's at a 6-week low of $4,967. I mean, that is a brutal, whiplash-inducing wipeout. And it all seems to lead up to March 18th, the day the Federal Reserve makes its big announcement. This timeline, this is our first big clue. And that date brings us to our number one suspect in this whole mess, the Fed's hawkish hold. Now, to be clear, the Fed didn't start the fire, but its reaction to the fire was really the first domino to fall. And to understand why they did what they did, we have to look at what else was happening because of that conflict. You see, this wasn't just some abstract geopolitical tension. It had very real, immediate economic consequences, namely an oil shock. Crude oil blew past $100 a barrel. And that, well, that doesn't just mean it costs more to fill up your car. It lit a bonfire under the fear of runaway inflation. And you better believe the Fed was watching this, knowing they absolutely had to do something. And this just shows you how fast the game changed for the Fed. Just look at the difference. Back in December 2025, everyone thought 2, maybe even 3 rate cuts were coming in 2026. Cheaper money was on the horizon. But fast forward to March, and bam! The oil shock completely flips the script. Now they're saying maybe 1 cut, and not until the very end of the year. Oh, and by the way, inflation's going to be higher? That's not a small change. That is a seismic shift in policy. So to put it really simply, the entire market was cruising along, fully expecting rate cuts. That was the assumption. But the Fed came out and sent a totally different message. Nope, interest rates are going to stay higher for longer. It's like the music just stopped. The party was over. And boom, the dominoes start to fall immediately. First, the US dollar goes on a tear. Since gold is priced in dollars, a stronger dollar just automatically pushes the gold price down. At the same time, you've got treasury bonds looking really attractive with their high yields. This is what we call opportunity cost. Suddenly, you have to ask yourself, why am I holding this shiny rock that pays me nothing when I can get a safe, guaranteed return from the government? All at once, holding gold became a much, much more expensive choice. But believe it or not, that's only half the story. The Fed's decision, that was the trigger. The explosion, though, happened deep inside the plumbing of the market itself. So let's talk about where the real fireworks happened. Let's talk about the Great Paper Flush. To really get this, we have to understand what the paper market actually is. Most of the gold that gets traded every single day isn't actual gold bars sitting in a vault. It's financial instruments, it's futures, it's ETFs. They give you exposure to the price without having to own the metal. And that last word there? Leveraged. That is the most important word in this entire story. It means traders are using borrowed money, which juices up their gains, but it also magnifies their losses. Okay, so you have this incredibly leveraged system, and the Fed just lit a match. Here's the brutal chain reaction. First, the crisis and the strong dollar create wild price swings. This absolutely squeezes all those leveraged traders who bet on gold going up forever. Suddenly, their brokers are calling. They're getting margin calls, demanding more cash right now to cover their losing bets. And how do you raise a ton of cash in a panic? You sell whatever you can, whatever's liquid. And for many of them, that was their paper gold. This flood of forced selling hits the market, which then triggers all the automated trading algorithms, and you get a full-blown price cascade. This wasn't people losing faith in gold. This was a desperate, mechanical scramble for cash. And if you want to know just how big this scramble for cash was, here's the number. $2.9 billion. That's how much money fled from the world's biggest gold ETF in a single day. It was the biggest exit since 2016. Let me be clear, this wasn't just a few nervous investors selling. No, this was the system itself, forcing a massive, brutal liquidation. But here's where the story gets really, really interesting. This whole paper flush, this panic in the financial markets, was completely disconnected from what was happening with actual physical gold. These are two different worlds, and back in March 2026, they were telling two completely different stories. And this quote, this says it all. It is maybe the most important sentence to understand this entire mess. You cannot get a margin call on a gold coin. If you're holding the actual metal in your hand, you're not part of that leveraged game. You're outside the system that just blew up. So let's really put these two side by side because it's like night and day. On one hand, you have paper gold. It's all about leverage, about needing cash fast. It's subject to margin calls and forced selling. And during the crisis, its price plummeted. But on the other hand, you have physical gold, coins and bars. That market is driven by real, long-term demand. There's no one on the other side of your trade who can go broke, and nobody can force you to sell it. And while the paper price was crashing, the demand for physical metal, it held up just fine. The panic was entirely contained in the paper market. Okay, so let's tie this all together. Let's put all the puzzle pieces on the table and see what this event taught us about the new rules of risk in today's markets. So here it is, the complete anatomy of the crash. First, a geopolitical crisis creates an inflation shock. Then, the Fed reacts with a higher-for-longer policy to fight it. That, in turn, boosts the US dollar, which finally squeezes all the leveraged traders in the paper gold market, forcing them to sell. And the result? A massive liquidity-driven price crash. This is so important. It wasn't a fundamental crash. The safe haven didn't fail because it was no longer safe. It failed because of how it was being traded. And here's what you really need to remember from all of this. The big, long-term reasons people own gold, things like central banks buying it by the ton, government swimming in debt, none of that changed. Those fundamental drivers were all still there. This crash was purely about the mechanics of the market. It was the plumbing that broke, not the foundation. And that leaves us with a really big and, frankly, a pretty difficult question for the future. We've just seen how the price of the ultimate safe haven asset can be completely hijacked by the mechanics of the paper market. So if even gold can experience this kind of gut-wrenching volatility during a crisis, what does safety really even mean for investors today? It's definitely something to think about. Thanks for tuning into this breakdown.